Hi there, good afternoon. It's that time of the day when we answer all our viewer queries, and it's that day of the week where we answer all the mutual fund queries of our viewers. This is Mutual Fund Corner or MF Corner. I'm Mangla Malu. With me is Sumaira Abdi in the Mutual Fund Corner. Good afternoon, Sumaira. We will answer the mutual fund queries, but just a look at the markets. The Nifty has petered out a little bit, back in the red for the Sensex, which is lower by about 15 points. Nothing really to worry, just a bit of consolidation. A couple of stocks which are losing. Yes Bank is at the low point of the day, and Tata Motors, after that big rally yesterday, is seeing some bit of profit booking, perhaps currently off the high point of the day. We will keep an eye out on individual stocks, but first up, all the top stories that we're tracking this afternoon. Key indices, they're off the high point of the day, also off the low point of the day. IT and energy stocks, they gain while the banking set underperforms. Mid-caps fare just a shade better. The Nifty Bank, however, underperforms. It's Reliance which rallies after Jio records over 97 lakh subscriber additions in June. Idea 2 rises on good numbers. Bharti Airtel sulks, however, as the company records lowest additions at just about 10,000 subscribers. Cement stocks, they're higher in trade today after a bullish report by Macquarie, which pegs the earnings for cement companies at an inflection point. India Cement's management says first quarter capacity utilization for the company has touched 80%. The aviation industry sees a robust 21% passenger growth in July. Jet Airways, however, under pressure after posting the slowest growth among peers. Jet's market share too fell to 15.1%. This compares with 16% at the start of the year. Alright, so with that, we will toss over to Sumaira, who is in the Mutual Fund Corner, to answer all your mutual fund related queries.
Mangalam, thanks very much for that. And joining me this afternoon, I have Harshvardhan Roongta of Roongta Securities, who will be answering all the queries that are being sent in by our viewers, and there are quite a few. Harsh, good afternoon. Thanks very much for joining in. Let's get cracking right away. So our first caller is Charmi Doshi, who's on the line with us from Mumbai, and she in fact has SIPs going on in multiple funds simultaneously. So she is looking to have her portfolio assessed. Charmi, hi, good afternoon. How can we help you?
Hi, good afternoon. Thank you so much for taking up my query. So,
no problem.
like I had mentioned, I have some, so these are the ones that I've planned to invest, 5 mutual funds, and I've tried to spread it across emerging funds, large cap, ELSS, which have some large cap and mid cap components. All I wanted to know is this like a good portfolio? So, and about the time frame. So right now I have no exit time frame in mind. So like I can keep going on in them until maybe like, you know, 4-5 years or maybe even more than that. So time is not an issue for me. So all I wanted to know is the allocation. Like I try to put in different fund houses and different kinds of schemes. I just wanted one opinion on whether it's to go and should I just start them, or is there any other modification which should be made in this portfolio?
Okay, Charmi, I want to start off by congratulating you because you're only 22, but you have taken a very, very practical approach to investing. The primary thing, of course, is to invest as early as possible, and at 22, you couldn't have done anything better. Also, your portfolio is looking quite strong, actually, but I'm going to leave it to the expert, Harsh, to actually analyze that. Harsh, she wants to build a certain portfolio, which she has laid out for us. You've had a chance to look at it. How would you analyze it?
So, well, Sumaira, you know, at the first instance, not often do you come across investors who've, you know, correctly allocated within the large cap, mid cap, the tax saving schemes. Beyond that, she's even gone and, you know, she's removed as to what is the actual allocation of a particular scheme in the large cap category, in the mid cap. So I think overall she's done a really good job, I mean, to begin with. And, you know, Charmi, if you're starting off with such kind of research, I'm reasonably sure you'll do very well for yourself in the investment world at least. So, you know, besides the fact looking at your portfolio, well, you can definitely go ahead and start investing into these schemes as you've selected. Your question was that should I, you know, invest a 40,000 in just 5 schemes? Yes, of course, you can do that because there's an adequate diversification which you need to take in. In addition to that, you seem to be somebody who could be seriously watching your portfolio. You can track it. So in that context, I would recommend that you can also look at direct options. So within mutual funds, when you make an investment, there is one, like you've taken a scheme which is Aditya Birla Tax Relief 96. So there is a regular plan and there is a direct plan. And direct plan is for those investors who can basically manage the portfolio on their own, and they are quite knowledgeable to do so. You seem to be the kind who fits into that profile. So I recommend that you look at even direct options, because the fund management cost on a direct plan is far lesser than what it would be on a regular. So that translates into direct saving for you. So you could possibly look at that option and begin with your investments in the schemes that you've already shortlisted.
Charmi, I have a question for you. Are you an investment professional?
I am working in the investor relations team for one of the Aditya Birla Group companies, and I am a chartered accountant, so yeah, that sums up.
All right, so that solves the mystery for us, but good going, and I hope this helps you in your financial investments journey as well. All right, up next we have a query coming in from Hari Shankar, who writes to us. He wants to know if he should move his investment, which is currently in the Axis Long-Term Equity Fund, to a small cap fund. Now, I wish we had Hari on the phone with us, Harsh, because I'm sure we have a lot of questions as to why this sudden decision of his. But the Axis Long-Term Equity Fund itself, I was just seeing the performance actually over the short term. Over the last 2 quarters, it's #2 in its category, which is not too bad to say the least. Therefore, how would you assess his investment in Axis Long-Term Equity Fund, and is a move warranted to a small cap fund?
Not really. So as you said, I wish we had him online. So because there were a lot of things that we would need to know. So to begin with, if you're looking at an Axis Long-Term Equity Fund, well, quite certainly this is an ELSS scheme which helps you save tax under Section 80C, and the allocation within this scheme is about 70% in large caps. So the question is. And as you said, the scheme is a good performer in its own category. So there is no, kind of reason wherein you would want to move out of a tax saving scheme in which you started investing with the primary objective to save tax and also get the long-term benefits of equity investments. Now, from this, you would suddenly move and think of allocating money towards a small cap fund. Well, I'm reasonably sure you are, looking at the returns that small cap funds have given in the last 2 years. But that really isn't a driving force in selecting the kind of scheme that you should be investing in. So my recommendation is, do not just look at past performance of a particular category. Maybe a mid and small cap category over last 2 years would look very attractive, but that does not mean that they will continue to give the same kind of returns in future. In fact, we've seen in the last couple of months, the mid and the small cap category have taken a huge beating as well. So stick to your goals, stick to the objective, which is tax saving and equity investments. Axis Long-Term Equity Fund within that category is a good performer, and you can certainly continue with it. Do not try and just look at past returns and try and move around with your portfolio.
All right, up next we have Vijay Bhatt, who writes to us on Facebook. He wants to know what is Harshvardhan's take on the Axis Mid-Cap Fund. Now, this looks like a pretty interesting question actually, Harsh, because in its category currently it's the best performing fund, right? Now, there are 2 questions that arise from this. One is that, as you check over the longer period, like if I see a 5-year period, the rank drops drastically to almost 25-30 range. Also, has the time come to start looking at mid-cap mutual funds again?
So there are 2 things. As you said, the first part is when you look at a performance of a scheme. So there would be a period which is say 2 years. So Axis Mid-Cap, is almost the top performer in the last 2 years category. You also have to evaluate the mid-cap segment by itself. The mid-cap space by itself has got a very good return in that last 2 years. So maybe they have just done well when the markets were going up and the mid-cap stocks were going up. What you need to do in a mid-cap category particularly is the fund management skills. What happens in the mid-cap space is, particularly that you need to really look at a fund which has got a stable and a consistent performance over a longer period of time. When they've seen the bear phases, when they've seen the bull phases, they have to see all those phases, because mid-cap is all about stock selection, and the fund management skills will actually start playing around when the markets are not even going to do well. So in that category, I would suggest that there are 2 other funds which have been in existence for far longer period of time, and they have been a very good consistent performers. So an HDFC Mid-Cap Opportunities Fund and a Franklin India Prima Fund. Now these have been in existence for a very long time. They've seen all the different market cycles. So it is advisable that you pick a scheme within these 2 options that I'm suggesting. The second question that you had was, should investors start looking at mid-cap again? So last couple of months have been very painful for the mid-cap segment. So there is no doubt on that part. The question is, there would be certain allocation to mid-caps. There is no doubt on that. Whenever you're creating a portfolio, you never, how do you create a portfolio? You look at, what should be a core section of your portfolio, which could be large cap companies. So maybe 50 or 60% you will invest into large caps. 20-30% you will allocate to mid caps, because a mid cap has the potential to become a large cap. So you would want to expose yourself to that as well. So yes, you couldn't have a certain allocation to mid caps, but restrict that to about 20-30%, so that the core portion of the portfolio is actually with the blue chip companies.
All right, so Vijay, I hope that answers your query. Up next, Anish Divani has written to us. He wants to start investing in a balanced mutual fund and wants to know the top 5 balanced funds with their past returns. So Anish, 2 parts to your question. One is that, what is the idea per se as regard to investing in balanced funds? And secondly, if you're just looking at a list of top 5 with returns, I think there are plenty of forums available online where you'll find, the list on various parameters, of course, performance being one on them. But Harshvardhan, to his first query, which is that, he's 35 years old, he's a professional. His question is that he wants to start investing in a balanced mutual fund because he is looking at 50% exposure to equity and 50% exposure to debt. Now, balanced funds technically don't meet the exact criteria, which is 50-50. It's more like 60-40 almost all the time. Is this something that you would recommend to him, that he go in for a balanced fund? I mean, this is assuming that all his other needs are met through the rest of his portfolio.
Yeah, so if you just look at Anish's query, he also says that he has never invested in mutual funds earlier, and he wants to start investing. And it is understandable for a new investor who comes into, say, probably equity and even mutual funds, to think that I want to divide my money equally, so that, and that's usually a suggestion that we do also give. The only concern is, if you, as you rightly said, that if it's a 50% equity and 50% debt, then that scheme by itself is categorized as a debt fund for taxation purposes. So even if you're investing 50% in equity, the taxation, the tax will be levied as if it is a debt fund. So, what is important is not only look at asset allocation, you also have to look at your time horizon. What happens is, I really don't know how long does he want to stay invested. In case he is okay to stay invested for more than 10 years, then there is a market volatility which he can mitigate in the form of an SIP. So if you're doing an SIP, you mitigate the market volatility. So your fears of volatility are kind of addressed to a certain extent. On the other hand, as you mentioned, the balanced funds would have a minimum exposure of 65% in equity, only so that it is called an equity fund from a taxation perspective. If after all this, you still want to allocate only a 50-50 equally, I'd recommend that you do not take one scheme together. Invest a 50% into equities, so that at least that 50% you will get the tax benefits of an equity fund. The other 50% you choose a debt fund itself, so the taxation will be on a debt side. Or else you have a choice to take a hybrid fund, which is 65% minimum in equity, so that the beneficial, you can get the benefits of an equity taxation. In any case, so this I'm assuming that he may not have got all his answers that he was looking for. What I recommend, because you're a new investor, unlike Charmi, where we were suggesting her to go on her own, in this case, you should take advice of a financial advisor. Understand what are the different aspects of dividing this portfolio, either directly into equity funds and debt funds, or a combination with a minimum of 65% in equity. So these things you should possibly sit down with an advisor and chalk it out and sort it out for yourself before you start investing.
Yeah, and Harsh, there are 2 more parts actually to his query. One is that he says, is it possible to put lump sum amount without a fixed schedule? So he's also contemplating whether or not he should go down the SIP route or the lump sum route. And secondly, he wants to know if there are any terms or conditions which are important before buying into a mutual fund. So I think both of these go hand in hand, but any words from the wise about why an SIP matters, I mean, at least for a new investor? Absolutely,
because see, what happens is, a lump sum is when you invest the entire amount that you have with you in your hand, which you put a pocket and invest it either in equity or debt. SIP is that you do not want to time the market, you do not want to take the risk of the entire capital, and another part would be that you do not have the capital in your hand right now. When you get a salary or something which is coming every month, you would invest it every month. So this is the a sense as to why a person does an SIP and why a person does a lump sum. Well, if you've opened a folio with a lump sum investment, that's his actual question. He says that if can I make lump sum investments regularly? Yes, of course you can do that. What you do is, first time when you make an investment, you'll get a folio created for yourself, and in that same folio, as in when you have liquidity, as in when the money comes into your hand, you can start investing in that folio, and there is no fixed amount. Say first time when you started, you invested with 50,000 rupees. The next time you can do as little as a 5,000. The third time you can do a 7,000, and you can do a 7 lakh in the fourth time. So there is no fixed amount in that case which you can do. Now the question also arises, how how do you go about investing? So that is why I summed it up to say that because he has so many questions, which are so many moving parts, he's just trying to figure out and trying to understand mutual funds. My suggestion to you is that meet somebody in person, you know, because there are lots of things that you would need to look at and understand before you start investing in mutual funds. So just try and understand first, get your basics right as to what do you want to do, how you want to go about doing it, and a financial advisor would be a best person to guide you through this process.
All right, so Anisha, I agree with Harsh on that. Actually, you should take professional advice before you make your investments. A quick break on that note, but remember that you can email us all your mutual fund queries and we'll address them on our show. We'll focus on some more questions when we return. Do stay tuned. Hi, welcome back. You're watching MF Corner. Well, our show is also live on Facebook and we're getting a live query coming in from there. Rajesh Gowda has written in to us. He wants to know which is the best category of fund to park emergency money. And in that particular category, he wants to know which fund he could choose. So Harsh, this is a question that we've also received quite often actually from a few viewers who've taken out money for a certain allocation, but since that gets deferred a little bit, they don't know what to do with it for say a period of sometimes 10 days, 15 days, going up to a month. So in this case, would you suggest some sort of a liquid fund would be the best bet?
Absolutely. So Sumera, there would be two options. One is that you have money lying in your bank account. You don't really know when do you need it, but you don't need it in the immediate future. So you don't want to earn a 4% return that your bank gives you or a 3.5% that the bank gives you. What you could do in the first instance is, if you know exactly how much time you don't need it for, say a 15 days or a 30 days, at least the least you could do is move this money from a savings account into an FD with the same bank for a 15 days or a 30 days. You'll get slightly more than what your savings bank account gives you. Alternatively, if you're equipped, you have a folio created and you're equipped for the KYC things to be done, a liquid fund or a short-term debt fund, these are most appropriate for these kind of allocation of money, because they don't have a timeline. The moment you park your money, or you start generating returns for the number of days that you are invested, and because they are short-term debt funds or they are liquid funds, they do not have exposure to long duration papers as well. So the volatility is far less in this. The essence is that you can withdraw the money if you wish anytime, and until you're invested, you will get returns which are potentially higher than a savings bank account. And the liquidity in this perspective is that if you give a redemption request before 3 p.m, you will get your money next day in your bank account. So it's as simple as that, and you could just park your money, leave it as long as you don't need it, and then take it out in a day's notice.
All right, up next, we have a query coming in from Remya Menon. She wants to invest 10 lakh rupees via SIP in good dividend giving funds and wants to know which funds to invest in. Now, Harsh, this becomes a tricky question because one, I don't know how she's planning to stagger this 10 lakh rupees in a SIP. Second is, post this whole SEBI rejig, I don't know if there is a good dividend fund in the mutual fund category. So what would you say?
No, in fact,
I mean, apart from arbitrage funds, what would...
No, so in fact, what I understand from this, there are two elements. One is that you're looking at an option to invest, which is giving out dividends to you. Okay, or the other, if I understand correctly, she might also want to pick a dividend yield fund. So basically, these are equity schemes in which the stock selection is done.
Yielding stocks, right.
So which are investing into stocks which are which have a good track record of giving out dividends to shareholders. Now there's a good strategy quite often, because if you're choosing a dividend yield fund, you essentially are investing into companies which have a good dividend payout ratios. Now when you talk about companies which are paying out dividend, it essentially also translates to say that these companies have been earning profits. Only then would you give out dividends, right? So your stock selection narrows down to saying that I'm investing in companies which are profitable, which have been rewarding shareholders in the form of dividends. So if that is your strategy, well, you could definitely, I can give you 3 schemes because you're going to invest 10 lakhs. You may want to invest and split it into 3 companies. A UTI dividend yield fund, Birla dividend yield fund, and an ICICI dividend yield equity fund. These are the 3 options that you can split your money into and invest into these. In case you're looking at any options which only gives out dividends, then you'll have to first identify what is the time horizon you're investing for. Because if you're investing for a short period of time, then it will be liquid funds. If you're investing for a longer period of time, you could go for equity schemes with a dividend payout as an option.
All right, we have another live query coming in on Facebook. This time, Sadesh Kulkarni has written in to us wanting to know the future of Franklin's latest NFO. So I'm checking on the Amphi side, and that information is also going up on our screens as well. Franklin has a fixed maturity plan in FMP, right? Series 4 Plan C, which is a 1,098 days. Okay, it's a close-ended fund, and the NFO closes on the 28th of August. Harsh?
Yeah, so if you're looking at fixed maturity plans, the essence of a fixed maturity plan is that they will invest into papers. These are debt funds. They will invest into papers with a maturity of 1,098 days. So the maturity of that paper which they're investing into matches with the duration of the fund. So in a sense, you will not have that volatility regarding the interest rate. If the interest rates go up, you'll have NAV fluctuations. That doesn't really affect you in this particular case. So when you're looking at an interest rate scenario which is reasonably high at this juncture, and you want to park your money with this kind of and lock in your benefits over 3 years, well, you can consider investing into these. And there's not much to actually evaluate and dissect into the scheme like this. It's more to do with the fact that you're going to park your money for 3 years, and you will lock in the interest rates which are available today in the market, and then you're not affected by the fluctuations in the interest rates in the next 3 years.
All right, so Sadesh, I hope that answers your question as well. We'll take a very quick break, but when we come back, it'll be back to markets and lots more stock specific action. Harshvardhan, thanks very much for your time this afternoon.
My pleasure.